Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, please have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets is not your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. Last week in my note, I started to discuss around the fact that back in vogue over the next couple of years will be central bank differentials. Now, when you outlay them on a dovish to hawkish scale, clearly they're all technically still dovish, and that needs to be fairly much recognized before I go any further. But if you look at it, they're not all at the very extreme end in terms of where we sit with the COVID world and the way that they've handled the pandemic. The Bank of Canada is the one that I highlighted, which has clearly started to signal that it's probably leading the pack with moving back towards a more neutral path, and I use that hesitantly. They're dovish, but towards a more neutral end rather than somebody, for example, like the ECB or the BOJ, which are clearly as dovish as you can get with their tapering program. So seeing it move from 4 billion Canadian dollars down to 3 is a step that we knew was coming. They certainly delivered on it, and you would expect, considering the data that's coming out of Canada at the moment, forward looking, expectation would be that they continue on their current path, and that's what they said is conditional for them moving on their quantitative easing program, that they'll start to slowly but surely unwind that. It's why CAD has been so strong over the last 2 weeks. So the question that then came is who's next in that line? The Bank of England and the Federal Reserve are probably the two that we'd point to that. We know the BOE has started to become a little bit more optimistic with its view. They're suggesting and using the terminology around the idea that they could start moving away from their current programming. The UK clearly has done quite well with its vaccination program, and things are starting to improve. So they're one. The other one is the Fed, and I'll come to them in a minute because I just quickly want to run down the line. You've also then put in there the RBA and the RBNZ. Both of those are very much on the dovish side. The RBA is very interesting. The CPI numbers last week were poor in terms of my view, that they were below what I think was expected by the market. So the RBA is okay with this, but it means that their view around not raising rates till 2024 is probably correct. Inflation is starting to go back to pre-COVID problems with regards to wage growth being anemic, and that we're not having the kind of level of consumption or particularly private investment drive to really put inflation up. So the RBA is out of the equation as well. The RBNZ has a similar problem, but it's also got macroprudential and probably fiscal risk into it. And what I mean by that is that there is a clear mesh now between monetary policy and fiscal policy over in New Zealand, and the Jacinda Ardern government clearly has some certain agendas that it's now also driving through monetary policy. So it's not as easy to get that differential, and that's probably why I leave the Kiwi alone. So the Fed, because in the end, where does the Fed sit on this sort of spectrum is part of the answer, but also all roads lead to the US. Let's put that out there. It doesn't matter if it's bonds, equities, or FX, all roads lead to them and where they position, because it's either a pairs you're dealing with, and when you get to crosses, you start to get a little bit difficult. So your opinion about the US dollar and therefore pairs comes through what goes on Constitutional Avenue. And at the moment, the Fed is more dovish than I think the whole market really expected, both the bond market and also the FX market. And that was probably true with what we saw in their statement. I think the biggest takeout, you can see that they let their mandate as is. They're not changing their current scenario. Yes, they upgraded their growth forecast, but not by much. Overall, they see inflation as being an event, but they see it as transitory, not statutory, and therefore, for that reason, they're not that worried about it. I think the biggest takeout, and therefore putting them on that spectrum, was when, during the Q&A session, Jay Powell was pushed on what he believed should happen around QE, and he very clearly stood up and said, at this time, it is not worthwhile discussing the end of the 120 billion US dollar per month QE program. I think that's a big full stop for at least the next 3 months, because that was clear from the reaction that we saw, particularly in the bond market, that is basically don't fight the Fed is coming to fruition, as it always does, in where we sit. So that actually therefore saw a really interesting movement, in my view, from what's going on in Eurodollar. Eurodollar is facing a little bit of a push-pull crisis, because the ECB is not going to like it above 120, and at 121.5, it's starting to get right up at the top end of that band. Watch that pair quite closely. If there's a confirmation of a continued movement up and a long call in the euro above 122, that's a real change. And I think you could possibly start to see some real interesting movements around it. but it would bring the ECB into play. They get really, really antsy when it gets above 120. So just watch that space. It's quite an interesting one with regards to where it sits. I'm not going to talk about cable because cable's stuck in a really tight trading range of around 139. And if you're honest, it's probably a little bit boring. Do need to look at dollar yen, and dollar yen again continues to be quite interesting. It is well and truly caught on that movement with regards to what we see inside the bond market. It can't get through 110 at the moment, and that's fine. But every time the bond market sort of drifts higher on the yield side, taking dollar yen with it, it quickly reverses when you get an event like the Fed. And that means that the bond trade is still very much driving that pair, and I still like watching and trading that one because I think it's still got a very clear mandate of what's moving it, but it could be coming slowly to an end. And I can tend to want to see what could be the next driver for it. And if it's not the bond market, you have to ask what is, and at the moment it's hard to sort of make out an example of that. Just finally, coming back to the Aussie dollar, I know I said that the RBA is a little bit dovish, more dovish than what's going on with the Fed and probably out of the whole curve. But what is going on inside the Aussie is iron ore, and that's outside of the realm we normally talk about. It's an individual event with record all-time high prices in iron ore, and that's not slowing down anytime soon. The Aussie's probably actually outside of that remit. So just be aware of that. It's not falling into the differentials. It's not falling into the bond market. It's found another thing to latch onto, and that's clearly the iron ore price.